Welcome to Alpha Insights. I'm Juniper. Today we're unpacking why Amazon's valuation reset has some analysts talking about upside, and I've got tech analyst Drew with me to break it down. Remember, if you have questions as we go, you can ask us at stockalpha.ai.
Thanks, Juniper. Great to be here.
So Drew, start simple for listeners. What's the basic thesis on Amazon right now?
In short, the data suggests Amazon combines a massive retail engine with a high-margin cloud business in Amazon Web Services, and that mix is producing strong free cash flow and return on equity. Analysts have been emphasizing that today's multiples are below recent peaks, which opens the conversation about upside if execution continues.
Interesting.
Yeah, that's a good point.
Walk me through the numbers that matter for someone trying to understand whether that valuation gap is meaningful.
Okay, Amazon's market value is roughly $2.1 trillion. Trailing revenue is around $717 billion, with net income near $77.7 billion. Earnings per share on a trailing basis are about $7.17, and return on equity is about 22%. They also sit on more than $120 billion of cash and equivalents, and free cash flow remains solid. Those pieces together explain why analysts still give Amazon a premium relative to traditional retailers. AWS lifts margins and cash generation.
So AWS is the margin engine. How are analysts sizing the upside, and what assumptions drive that?
Analysts are looking at a few levers: continued AWS margin expansion, better monetization from advertising in Prime, and improving logistics efficiency. The consensus price target sits around $281, which implies roughly 39% upside from recent levels. Some firms are even higher. One shop moved a target to $315, and those models lean on steady AWS growth and stronger advertising revenue per shopper.
Right.
And importantly, valuation metrics today are below the peaks we saw in the big tech rallies of recent years. Trailing P over E is in the high 20s, about 27.5, and forward P over E sits a bit lower, around 25 and 8/10. So the story is similar growth expectations, but somewhat lower multiples than the highs.
Let's talk risk. What could make that upside evaporate?
There are a few clear risks. Retail margin pressure from competition or higher freight and labor costs could hit consolidated margins. A macro slowdown or an advertising pullback could slow revenue growth. Regulatory scrutiny or large capital outlays for logistics would also chip away at free cash flow. Analysts often point to those as reasons why multiples can re-rate quickly if the top line or margins disappoint.
Got it.
Another practical point. Even though Amazon trades below its recent peaks, it still commands a premium to many retailers because of AWS. So valuation risk is real if cloud growth slows or enterprise customers pull back.
From a tactical perspective, what should listeners watch next?
The big near-term catalyst in the report we reviewed was an earnings event in late April. Management commentary there on AWS growth, Prime trends, and advertising monetization was flagged as a potential reset. Beyond that, watch AWS margin trends and advertising revenue per user as early indicators. On the chart side, the stock has recovered from the low near $161 and has been consolidating above the $200 level, with resistance around $225 and the prior high near $258.60.
So a lot of attention on margins and ad monetization. Any final thoughts on positioning and strategy?
Analysts generally remain constructive. The consensus leans towards strong buy, but they also emphasize measured sizing because of short-term volatility. For longer-term holders, the key is conviction in AWS and ad growth over multiple years. For traders, earnings events and margin updates tend to create swings, so defined risk controls matter. Again, this is analysis and market context, not specific investment advice.
Okay, before we wrap, let's give listeners 3 quick takeaways.
Sure.
Key takeaway 1. Amazon's mix of large retail scale and a high-margin cloud business is keeping free cash flow and return on equity healthy, and that underpins the upside narrative. Key takeaway 2. Analysts' mean targets suggest meaningful upside, but that depends heavily on AWS margin trends and advertising monetization. Those are the two things to watch. Key takeaway 3. Near-term volatility and execution risks mean measured position sizing and close attention to guidance are important for anyone tracking this name.
Honestly, I was a bit surprised by how many models still leaned bullish despite the pullback. Data suggests there's room to rebound, but the story is very execution dependent.
If you have questions about anything we discussed today, you can ask us directly at stockalpha.ai. We answer listener questions live. And for more market insights, head over to stockalpha.ai.